us from LGFA. Welcome. Just getting into our council blessing. I don't mind doing that. Ia mātou e whiriwhiri ana i ngā take kei mua i o mātou aro e pono ana mātou kakaha tonu ki te whakapau mahara huapai mo ngā hapore e mahi nei mātou. Me kaha hoki mātou katoa kia whaihua kia tōtika tā mātou mahi, a mā te maia te tiro whakamua me te hihiri, kataia, te arahi, I roto I te kotahitanga me te aroha. Cool. All right, moving on to item number 3, apologies. One from the Deputy Mayor and also Kim Tahiwi of Ngā Hapua Ōtaki, and also to note that Michael Moore has sent in his apologies for the hui as well. I'm happy to move those apologies. Seconded Mayor Holbrook, all those in favour. Aye, against, that's carried. Item number 4, declarations of interest. Have not been made aware of any, so with that swiftly moving to item number 5, public speaking time for items relating to the agenda. There are no public speakers this morning. Item 6, deputations. There are none. Members' business. There also are none. Updates. There are also none. So that takes us swiftly through to reports. We've just got one report in kind of the main body of our meeting today, which is the Local Government Funding Agency's Statement of Intent and Annual Report. So what we're hoping to get out of this report is a noting of the Statement of Intent 24 to 47 and noting Annual Report as well. 24 to 27 and noting Annual Report as at 30 June 2024. So welcome Andrew from LGFA, and we'll pass to you, or Ian maybe first, to intro the report and then, yeah.
Yep, thank you. Thank you, Madam Chair. And morning everybody, and yeah, welcome to Andrew. I believe you've been to this council previously, but good to have you here. Thanks very much. So the papers you've got in the pack relate to the LGFA Statement of Intent and Annual Report. As a CCO of council, we're required to monitor their performance and report to you. So you've got in the pack the actual documents themselves plus a brief summary paper over the top. But more importantly, we've got Andrew with us, and he has a presentation to take us through where he can cover off the key points around performance and outlook for LGFA, and also I think we'll talk a little bit about the water reforms and implications from a lending perspective. So Andrew, I'll hand over to you.
And if you could just save questions maybe until the end, so just note the slide and then we'll come to questions. Thanks, Andrew.
Okay, thanks, Madam Chair, and thanks, councillors, for the invitation to speak to you today. I'll go through the performance of LGFA relatively quickly and then sort of touch on water, and hopefully there's sort of lots of questions. We're spending quite a lot of time speaking to different councils around the country, and you know, it is a very busy time for you at the moment, sort of deciding on your strategy and what you're going to consult on early next year. Right. Okay, so just a very quick overview of LGFA. So LGFA is owned 20% by the government and 80% by councils. There's 30 council shareholders in LGFA. It's been going since 2011. We have 77 out of the 78 councils that are members. The only council that is not a member is Chatham Islands, and that's really because of scale. We have 72 councils that are guarantors of LGFA, and when I touch on water, the issue of councils guaranteeing LGFA and the risk of any change in strategy is quite sort of important. And we have 6 CCO members. We have just over 90% of market share of all council borrowing. We have a board of 6 directors, 5 are independent. 1 is from the sector, Alan Adcock from Whangarei District Council. And then we have a shareholder council which comprises the government and 9 other council members, and they provide direction to LGFA on the SOI and also they help in the selection of board members who are put up for nomination, which shareholders get to vote on. In terms of the performance, the top box is our operating profit. It was a difficult year in 2023. That really came about through having to hold a lot more sort of liquid assets because of the uncertainty in financial markets, and the sheer amount of borrowing that's going on by councils means to provide certainty in financing, we're having to hold a lot more sort of liquidity. But you can see the profit is back to just over 10 million last year and is forecast to increase in the future. That said, we're not trying to maximise our profits, so we're quite different from a bank in that respect, because the greatest benefit to council members is through lower borrowing margins. So to the extent that we become more profitable, what we've done in the past is we've tended to pass that back through lower borrowing margins to councils. The profits that we do make, we do pay a small dividend to our council shareholders, but most of the profits are just retained to build up equity in the business. And as a guarantor, that's important because we want the equity base to be growing in size as the lending on the other side is also sort of growing in size. So our shareholder equity to assets ratio is staying reasonably the same. And the bottom left-hand box, you can see just the growth in assets. So the assets are really loans to councils as the bulk of those assets. In terms of our performance, we sort of had no breaches. We've maintained our sort of credit rating. Our operating income was in line with forecasts. The one thing we didn't meet was our operating expenses were higher than the $10 million target, and we do like to keep our operating expenses in line with what's forecast. The reason for it is a little bit technical. So in the last 18 months, traditionally we've only issued bonds in New Zealand dollars, but we've outgrown the New Zealand market just because of the size of council borrowing that's going on at the moment. So we've done 3 issues comprising around $3.5 billion into the Australian debt market. That is all swapped back into New Zealand dollars, so there's no currency risk. But the issue is when we issue in foreign currency, we have to pay to the government what's called an approved issuer levy. So we have to pay 2% of the coupon on our bonds to the government. So it is a bit of a tax on council borrowing. We are trying to get an exemption. We're discussing that with the sort of government at the moment as to whether we can become exempt. There's no one in New Zealand that is exempt, so we're not sure how successful we're going to be. But all issuers actually have to pay this on this sort of tax. So because we weren't planning to issue in offshore currency, but were sort of pushed into doing so because of the amount of council borrowing, that's why that additional expense of close to $2 million of approved issuer levy occurred. Performance, sort of again, over 90% of council borrowing as mentioned, which is really good. So Auckland Council and Dunedin Council do a bit of debt issuance in their own name, but and that's because LGFA isn't able to finance all of Auckland's debt requirements. They're just simply, they comprise over half of the total sector borrowing. So if we did all of Auckland's borrowing, our portfolio wouldn't be diversified. So the rating agencies wouldn't look favourably if we had 50% of our lending to one borrower. So Auckland's LGFA's exposure to Auckland's around 18% of our lending book. But very pleasing, we have 93% satisfaction scores when we do our annual survey. So we'd like to think that we're meeting council demands in terms of low-cost borrowing and certainty of borrowing. Okay, one more. Okay, and on this page, the only other target that we didn't meet was sustainability loans. We had a target to do 2, and we've done only 1. But we see the whole issue around sustainability as a long-term journey, so we're not really worried about short-term performance sort of targets. We've actually just added a new resource, so we now have 2 people in that sort of space. And so we look forward to continuing our discussions with councils and sort of helping them in either sustainability or the climate sort of action space. I think the reality is the very large councils like your Aucklands, Wellingtons have a lot of internal resources in that sustainability space. When you go to the small rural councils, they just have no one in that space. So for them, they're really at the start of the journey, and they need LGFA to be the ones that sort of drive a lot of the work in that space. The other reason is all the water lending would be eligible for sustainability criteria, but because of the whole uncertainty of what is happening in that space over recent years, we haven't able to do any lending in that area because we always thought the loans would be taken away from us and transferred to new water entities. So it was sort of pointless if they were going to be taken away a year or 2 later. But LGFA is very committed in the sustainability space. This is just an overview of sector debt. So you can see what's happening, and this is the reason LGFA was created in 2011. People could see the start of the investment in infrastructure that was going to be required. If you think about the age of some of the infrastructure, and you can see that particularly in places like Wellington where things are reaching the end of their life, the concept of funding depreciation didn't come into the late 1990s. And so when you're talking 100-year assets, councils hadn't built up, the reserves, or at least those that had, like Wellington, where your assets need renewing. And so that's simply why councils don't have these huge cash reserves to do renewals. They're having to use debt financing to finance those renewals that occur. But the model going forward should be a lot more sustainable because councils are now all funding their depreciation. But for the next sort of 10, 20 years, we have this bow wave to get over in terms of infrastructure. And this is the rolling 12-month lending of LGFA, and just to show you why I sort of talked about having to go offshore for some of our money. So traditionally we were lending about $1 to $2 billion a year to councils, but in the last sort of year it has jumped up. So when it jumped up to around sort of $3-4 billion, we thought that was a lot, but it's now exceeded over sort of $6 billion. A reason for that, part of that was councils getting in ahead of the water reforms and doing their water investment before it was transferred to a new water entity, on the basis they thought any debt incurred would be repaid to them, which was quite logical. The other reason was incentives by government through things like shovel-ready sort of projects, the water sort of grants, the Provincial Growth Fund grants. A lot of those were co-investments and things. And the other reason is simply because councils need to do more infrastructure. And again, Wellington is the very obvious one where you can just see things breaking in front of your eyes. But you can see, so that's created a lot more work for us. It's meant that the sheer amount of financing from the New Zealand market we've sort of really outgrown the New Zealand market's capacity to supply all of this debt. We go back to the previous one. When I look at the LTPs and look at from the councils that have done one, there's still a few councils doing one next year. My estimate of sector debt's like 55 billion by 2034. So you can see this graph is just going to continue upwards. And that's why LGFA is serving a really important role, because it has the AAA rating, the same rating as the government. We are able to access debt markets in a very cost-effective way. Interestingly, most of when we issue our bonds, our largest investors is now offshore investors. So again, New Zealand banks, New Zealand institutions already have large exposures, but so really the growth of new debt really has to come from the offshore market. But the good news is they like the AAA credit rating, they like New Zealand as a story, and they like the sector. But when you're talking overseas investors, they don't want to invest 5 million or 10 million with Rotorua because they wouldn't even know who they are. But they like, you know, the credit story of the sector. Touched on that. So we've now got 39 councils with ratings. The first box is Standard & Poor's, the second box is Fitch, and the third box is Moody's. Only one council with Auckland with a Moody's sort of credit rating. But again, because of the increase in debt, once you get over 50 million, it's worth councils getting a credit rating. So we have had a few downgrades from Standard & Poor's in the last year. That is because debt levels have been increasing, and the other reason is because councils, after their capital expenditure, are running sort of deficits. So they're not running operational deficits, but after CapEx is taken into account, those deficits are growing in size. And again, that should be no surprise because councils are investing in infrastructure. Very good news that councils are largely balancing their operating budgets, not all. When we look out in the 2034 plans, it actually looks better than what I thought it would be, given the challenges that councils have had to absorb, you know, insurance costs, depreciation costs sort of rising, interest costs rising. So it's been a challenging period, but by and large, councils have, you know, incurred the pain of having to go through those large rate rises in the current year and a few more years potentially to come. CCO lending. So when we're talking about being able to lend to water CCOs, we often get the question, do you need shareholder approval? So shareholders gave LGFA the approval to lend to CCOs and CCTOs in 2019. That was providing they either guarantee the CCO or provide uncalled capital in the case of a CCTO. So the Local Government Act says that you can't guarantee a CCTO, which is why councils use the uncalled capital structure. Quite ironically, the reason in 2019 we wanted to get approval because Waikato Water was a very real concept, and if it was owned in their case by 3 councils, we didn't want to have to lend to the 3 councils and they pass all the lending through to the CCO because that's their water CCO, because that's an awful lot of transactions. You're multiplying by 3 the amount of transactions, and then all the interest comes back the other way. So LGFA being able to lend directly to Waikato Water made a lot of sense, providing the councils guaranteed Waikato Water. So from LGFA's point of view and the guarantor's point of view, the risk was unchanged. You can see our CCO members down the bottom. We now have 6 CCO members. They're all actually CCTOs, so trading organisations. 5 of them are owned by one council, but Infrastructure Holdings is jointly owned. That's owned by Nelson and Tasman. So we do have experience in jointly owned CCOs. And all the CCOs can access exactly the same lending products as councils can. LGFA lends to the CCO, even if it doesn't have a credit rating, we lend to the CCO at the same rate as we'd lend to the parent council. So in the case of Far North Holdings, Far North District Council has a AA credit rating, so we lend to Far North Holdings at the same rate. So yes, there's a risk when a council guarantees the CCO, but in the case of Far North Holdings, for example, because they can get a lot cheaper financing than bank financing, that allows the dividends that they're paying to the council to be higher. So the council is being compensated for that sort of risk. We can only lend to a CCO where it's 100% owned by local authorities and or the Crown. So in respect of water, there's nothing in the legislation that allows third parties to own it. So I don't think that's going to be an issue. In August, the Minister of Local Government announced that LGFA will be able to lend to water CCOs, and again, provided they are guaranteed by their parent council or councils. The government has asked LGFA to look at lending to water entities that are not supported by their parent councils, and we have said that we would do that. But if we want to go down that path, we have to come back and get approval from all 77 council members, because we have to change our multi-issuer deed. And so it requires not 50% support, 100% support. So we can't do that unless we presented a case to councils as why that wouldn't be incurring a lot more risk. And on the face of it, lending to water entities without any council support that were non-investment grade is a material change in risk. So it's our view that councils wouldn't support that, or not unless there was some sort of government assistance, like additional government capital, for example. But we've said we will sort of look at that sort of risk, and then we will go back to the government and discuss it with them and what the government might need to do. Why that's important is because Auckland Council have asked for legislation that provides financial separation from water care. They will own water care, but they are prohibited now under legislation from providing a guarantee or any new equity. So that means because there is no financial support, LGFA isn't able to lend to water care. And we wouldn't be able to lend to a water entity that was in a community trust. So out of the 5 options that council have, 4 and 5, LGFA is not able to help you with. So Watercare has to go to finance markets and raise debt in their own name. Under the previous government's 10-entity model, when they modelled it, only one, which was Entity A or Watercare, would have got an investment grade credit rating in its own name in year 1. All the other 9 were non-investment grade. So that's why it's our view that councils will need to provide financial support to their water entity, whether it's either 100% owned or a regional multiply owned sort of model, until they get to the stage where they can get an investment grade credit rating in their own name. And once they do, councils will have the option to do what Watercare is doing and let the water entity finance itself in its own name, if that's what councils want. Or you might think it's of benefit to the community that you can get AAA financing rates because it's going to keep water charges down. But that will be entirely your decision. LGFA is happy to support, while we've written to council mayors and CEOs outlining the option, just want to make it clear that from the LGFA board that we're happy to support you no matter which pathway you go down. So if you want to keep it in-house, you want to have 100% owned CCO, you want to be part of a a regional CCO with 2 or more shareholders, we will support you with that. I think in setting up a CCO, there's probably some scale because you have to put directors and things in place, so there are some costs. So I think for rural councils, having 100% owned CCO may not make a lot of sort of financial sense. For larger ones, there may well be some benefits, including the ability to gain greater leverage. So the Minister mentioned that a water entity, if it's in a CCO, will be able to borrow the equivalent of 500% debt to revenue. That's roughly double the gearing councils can. And we get asked, isn't that taking on more risk? And yes, it is. But when you look around the world, water entities or any utilities that have investment grade tend to work really well. So you can look at Australia, for example. Their reforms happened in the 1990s and onwards, but they've never had a water entity go bankrupt or default on its debt. So S&P rate water entities really highly because their revenue is really certain. So the credit metrics we're talking for the water CCOs are consistent with the water entity in time being able to achieve an investment grade credit rating. So we really think that, our interests are very aligned with your interests because we both want the water entity to succeed, and it has every chance of doing so if it has investment grade credit metrics in time. And regardless of whether it's in a CCO or whether it's in the council, councils have the risks of having to meet water standards now. So, the risks still exist whether you move it to a CCO or not. And the last thing we are looking for at our AGM next week is we are asking shareholders to make a change in the foundation policies, which would allow the LGFA board to approve a bespoke covenant for high growth councils and potentially to councils in the event of a natural disaster to give them additional headroom. At the moment, councils can apply for a bespoke covenant, but they have to get approval from shareholders to do it. So it's not a major change. All we're doing is saying, rather than having to go to shareholders, allow the LGFA board to do it. The reason we want to make it available for growth is because not all councils are the same. Some have a lot more growth challenges, and that requires more financing to do it. So we believe that while it's not a perfect science, growth does sort of pay for growth. So if you invest in growth infrastructure, in time it brings in development contributions, financial contributions, and additional rating units, which will in turn service the debt. So when we talked to the Infrastructure Commission about financing challenges, they said don't make it available for everyone, make it available for the right sort of things. We get asked what's our criteria going to be, and the board will have some flexibility. We started off with a list of councils that we thought might be high growth using what the Ministry of Environment traditionally sort of had. But in discussions with BIA, they suggested make it Tier 1 and Tier 2, and from that, those councils are able to put an application to the board. I think Kapiti's Tier 2 from memory. And the rough rule of thumb we're looking at, and we don't want to be totally prescriptive because growth can be for things like, tourism capacity. It doesn't have to be just all about sort of residential units. So but the rough rule of thumb we're looking at is sort of 10% population growth over the next 10 years. So we're expecting probably 4 councils to apply in the next year. But if that's a path you wanted to go down, then we're happy to have that discussion with you. So I'll finish there and take questions.
Yeah, great. Thank you, Andrew. Rattled through a lot of information in a short time and but really, yeah, nice and easy to digest. So thanks for all the visuals and graphs too. Councillor Wilson.
Thank you, Andrew. It's an excellent summary. Couple of questions. the largest investors now are offshore investors. So who are they? The offshore investors.
Yep, we do have information on that, which we put on our website in our investor presentation. They actually come from all around the world. Japanese investors are quite a big base. Europe is a big base. Some out of the Middle East. Tends to be less out of the United States. But a lot is like central banks, for example. We have some large central bank investors. Again, they're managing big reserve portfolios. They want high quality credit. And global investors often looking to create a diversified portfolio. So in terms of the countries they're investing in, they don't want it all to be invested, say, in the US in case something goes wrong in that particular sort of market. So it's a whole range, like insurance companies, just investment managers like we have here in terms of your sort of ANZs and Milfords and Fisher Funds. All those KiwiSaver managers are big investors from the New Zealand sort of dollar perspective. Tend not to have a lot of retail investors, and that's because LGFA bonds trade at a lower yield than where bank investments can be. So you can buy a BNZ bond at a higher yield than an LGFA bond because LGFA has got a higher credit rating than BNZ. So retail investors tend to chase yield a bit.
Yeah. So I just wondered about, in terms of ethical investing, so that tends to go that way, but is there a lens from LGFA? And I had some role in the original establishment of the LGFA, and at the time that was one of the things that was being talked about. So what checks are there on the ethical investing into LGFA?
That's a good question. So when we issue our bonds, we can't control who buys them. They're listed on the stock exchange. Anyone can go to their broker and buy things in the secondary market. We do hold a portfolio of liquid financial assets. So that's currently probably around $3.5 billion so we are investing in a range of securities. The primary driver of that is liquidity. We need to buy things that are high quality credit rated and relatively short dated and liquid, because we might need to sell them to provide financing to councils in the case that we're not able to issue bonds. That's unlikely, but that's the backstop we sort of have. We have a sustainability committee, which comprises 4 independent members. They push us really hard on this issue. So we do have a policy which determines, so we do have certain exclusions, but because we're only investing in New Zealand at the moment, we're tending, it's quite different than if you were in Australia. You'd have a lot more mining companies and things that were a bit more sort of contentious. So we do exclude things like Fonterra, Sky City because it's gambling, Genesis because of the coal power. I mean, you can argue those things whether it's necessary or not, but yeah.
Okay.
It's interesting. Things, again, like slave labour and things gets brought up all the time in our sort of discussions, but we're tending, because we're investing in New Zealand and the top echelon of sort of companies, it tends not to be an issue.
Right.
Yeah.
And I just wanted to, in terms of there's double the gearing for CCOs relative to councils. That up to 500%. If council sets up a CCO, and by the way, I don't think we've got a choice. I think you have to set up a CCO. I don't think you can keep it in-house. Well, you can't keep it in-house if you want to get that extra level of borrowing, right? So if you want that borrowing, and I just wonder, presumably there are constraints about what it's being borrowed for, or is the only constraint the CCO and its guarantor, which is presumably the council? what it can spend its money on.
Okay, I think there's a few questions there, so
Yeah.
I'll probably miss one or two answers. In terms of the strategy of the water CCO or the water management, if it's in sort of house, I mean, that's really going to be determined by the two regulators. So the water regulator, Te Mata Arawai, and the economic regulator, which is going to be the Commerce Commission. The economic regulator will be a big change for councils because currently you work under a model where you work out what your costs are and you recover it through, well, water charges or rates. So that will be a big change because once you have an economic regulator, you can no longer just charge what you want to sort of charge. And we're seeing that play out with Thames Water in the UK, where the regulator is not allowing them to increase prices by as much as they want. In terms of the leverage, one thing I should have mentioned is if you have a operational model, which is like Wellington Water at the moment, then you won't get the additional leverage. And I know Waikato councils are looking at that model as the first stage, so they're talking about doing an operational model first. In that case, the debt and the water assets remain with the council. So then the 280% net debt to revenue ratio still just applies to the council, so you won't get the benefit of the 500%. So to get the benefit of the 500%, you have to transfer essentially the debt, and you'd have a consultant that tells you, for a multiply owned one, you'd have to agree on some methodology for how much debt was sort of transferred, and then that would be able to borrow potentially up to 500% net debt to revenue. It's going to be a different covenant, a funds from operation covenant, but we'll give you more information on that when you want to get into those specific details. And that's consistent, the ratios we're talking about is consistent with Standard & Poor's giving the water entity an investment grade credit rating. So we recognise the covenants might not be able to apply in year 1 or 2 or 3, so there might be a pathway for the water entity to be able to get its revenue where it needs to be to meet this sort of covenant. So we're happy to work with you on that. A few other things like independent governance, requirement for water meters. We need to see what the third legislation is, but we suspect the government will push for 100% independent governance. But the council will still set the SOI, appoint the directors and things on that. So probably there's more questions in there.
No, that's great. And just a final point from me, I'm a fan of LGFA. I think it's the whole idea of it is brilliant. I just wonder if LGFA is feeling increasing pressure to do the sort of funding that the government itself used to do, and so instead of taxpayers paying for these things, now ratepayers are paying for it, and they're using the LGFA as the conduit for that. So you might be pleased that that's happening from an LGFA point of view.
I think you know the answer to that already. I mean, it's not LGFA, it's councils are being forced to
That's right.
Pick up a lot of the costs of what traditionally has been in the government space. I mean, the water regulation is, an interesting discussion because you've clearly got that tension between affordability and society's wants to have better sort of water standards. So, Te Mata Arawai, I heard Alan Pragnell, the CEO, speaking, and he said, next year, a third of wastewater treatment plants will be out of consent.
Yeah.
So that's a lot. So I guess we've had this loose regulation in the past, but no one's ever enforced things, which would mean councils have been very lax in trying to comply. On the other side, you look at Palmerston North and their proposed wastewater treatment plant. So that would be treating things to a better standard than anything else in New Zealand. So you can have that discussion about whether things are in gold plated or not, the cost on the community of doing that. We still don't know what the water standards exactly will be. So the government's reduce the need where there's less than 25 connections for that to become the council's responsibility. But we still don't know how long a council's going to have to comply. It's clearly not possible to get all these wastewater treatment plants consented within a year or fixed within a year. So how long are we going to have? The more years you can spread the capex over, the lower your sort of peak in debt will need to be. Interesting discussion. I mean, we've done a lot of work with the Wellington sort of region and the Hawke's Bay region because they're the ones with the most advanced financial modelling for a regional sort of entity. So you're really talking, a 20-year time frame to address some of these challenges. So for a period of time, there's going to have to be, higher charges to support the infrastructure which is needed. Sort of painful, but yeah.
Thank you, and good stuff.
Awesome. I'm not seeing any other questions. I just have one real quick one. In terms of the green, social and sustainability loans, can you just provide a quick example to us of a council that's received one and what project they've got it for? Because it looks like the criteria like resilience, adaptation, also mitigation, energy can be quite broad. So could you give us a couple of examples of projects?
Yep, we've done them. A lot of the initial ones were in the building space. So like the Wellington Convention Centre was one of the first ones we did. So it's really meeting a 5-star green building standard. So again, it's an interesting tension between doing a 5-star green building and the cost. But Whangarei's new civic centre came under that criteria. We've worked with Christchurch on their social housing. So they transferred their housing portfolio to a trust, and we now lend the council money and the council lend it to the trust. So the trust is getting very cheap financing. So that's the social area. And we've done things in the environmental space with Greater Wellington, with their Hutt River sort of project, Tauranga as well, with again an environmental project, working with Hawke's Bay Regional Council on another environmental sort of project. But again, the water will open up a lot more. And then we've done quite a few climate action loans with councils. So if you have an emissions reduction target, then all your borrowings can be covered by that climate action sort of plan. But we've got that additional resource in that space now, so
Cool.
We'll be doing more work in that area.
Great. Okay, thank you, Andrew. Not seeing any other questions. So we've got recommendations on page 6. Is there someone who would like to move? Councillor Wilson, seconded by Councillor Halliday. Right of introduction. I feel like you've contributed some comments.
I can waive that. Just to say, it's. I think it's the sector has benefited enormously from having LGFA, and I really enjoy the transparency that we get as a sector as well from LGFA. No one's come here and been shy to answer questions, which is really good. So appreciate your work.
Thank you, Councillor Holbrook. Or Mayor Holbrook, I should say. Sorry.
Yeah, thank you so much for that presentation. Really clear information, really well presented, and great to see the bounce back from last year. Really good to see that. And I just want to thank LGFA for the work that's been going on to prepare us for the water transitions. It really couldn't happen without LGFA, or if it was without LGFA, it would be at considerable cost and risk to councils. So we just really appreciate the work that you've been doing with the government and alongside them to make sure that we can achieve what we want to in the water space, particularly.
Yeah, so LGFA are really the financing part of the water changes. So you've got other people like Crown Infrastructure Partners that are better advised on some of the merits in terms of operating efficiencies and scale, things like that. And DIA are the experts probably in the legislative side. So it's really, use people like Crown Infrastructure Partners to get advice from, because I think hopefully everyone is wants the same sort of outcomes. So it's going to be a messier rollout than the previous government's one. So I'm sure change will happen, but it might just happen over more years. And we saw that with Tasmania, so I think that's a really good example to look at. Owned by 29 councils, they were all really opposed to the forced amalgamation of their water assets, but the government went and did it anyway. They started off, going from 29 to 3 water entities, but within 5 years they said, actually, it makes sense just to have one. And they were all really scared about, you look at the Wairarapa, they were scared about forced amalgamation once they lost their water assets, what would happen. But it didn't. They had this sort of the same regime that we did, that it has to go to a local vote. Both councils have to agree. And you've really seen very little in the way of amalgamation there. And I don't think anyone would regret in Tasmania now if you ask them about, are you pleased you sort of did it? I think everyone would be pleased. But you look at Victoria, they have, I think, 3 water entities for the whole of Melbourne, so that's roughly 1.5 million people each. And they have 15 regional models. So you can, even within Australia, you don't have to have one for a whole state, even though Western Australia and South Australia just have the one. So, yeah.
Yeah, thank you.
Great, cool. So moved and seconded. All those in favour? Aye, against. That's carried. Thank you, Andrew. Thanks, Ian, and appreciate you coming in person. It's great to see you. Cool. So that takes us to item number 10, confirmation of minutes, page 82. Is there someone who'd like to move the minutes? Mayor Holbrook, seconded. Councillor Wilson? Yep. All those in favour? Aye, against. That's carried. So now we will move into public excluded. Is there someone who would like to move that we, Councillor Coe, seconded, Councillor Warwick, all those in favour? Aye, against, that's carried. Community board members can stay. Yeah, I'm happy